Hello, welcome to preparation of financial statement series. We'll continue our discussion on the deferred tax effect on the financial statements. So the opening balance sheet is given and certain transactions are given. Sold 25% of the stock for 400,000. So for 400,000. And let us assume that entire sales is for cash, and whenever there is a sale there has to be cost of goods sold because of the matching principle. So 0.25, the stock will reduce to the extent of 25%. Dividend received from the shares in which we have invested. So the dividend received is 10,000, but it mentioned that the dividend is an exempted income, not taxable. So dividend is an inflow and an income. Interest on the loan, interest is 10%, 0.10. But it says interest has not been paid. So interest in the income statement will be shown, but in the cash flow no interest. So outstanding interest will appear on the balance sheet as a liability. Depreciation for accounting. Depreciation for accounting is 50%. Before that, let us purchase the plant purchase for 100,000, and plant will appear on the balance sheet as an asset. So depreciation on plant is 50% on RBM, and depreciation will appear as an accumulated depreciation in the balance sheet. Accumulated depreciation on the balance sheet will so AD is minus 50,000. Minus 50,000 is an accumulated depreciation by the end of the first year. Now we have all items of incomes and expenses. So we can find PBT. PBT is equal to 410 minus 124 is a profit before tax is equal to 286,000. But to calculate the tax, it is necessary to calculate the taxable income. So in taxable income, sales is same as income statement. Dividend is not taxable. It's mentioned that is exempted income, and so the total gross taxable income is 400,000 minus the cost of goods sold, same as accounting, minus interest, same as accounting. Interest, it says, is allowed only on payment. Since interest has not been paid, interest will not be allowed as a deduction, and depreciation is same as accounting. So we can see that the taxable income is not same as accounting income in this case because of the exempted incomes and because of interest. But however, interest will be allowed as a deduction on a payment basis. So interest is a timing difference, whereas the dividend leads to the permanent difference. When the PBT is not same as taxable income, tax profit is not same as taxable profit, then we have to show the tax expense as CT and DT. The current tax is paid on the taxable profit, so 0.30. Let us assume tax rate to be 30, and the deferred tax is the tax effect of the timing difference, and the timing difference is the interest. So in this case, there is a negative deferred tax. and the PAT will be interest, PAT will be PBT minus CT and minus DT and DT. So therefore the reserves will go up to the extent of the PAT, and let us assume that the current tax has been paid, so CT payable will not be there. However, the DT, the negative DT, will appear on the balance sheet as a deferred tax asset. We can now find the cash in hand. Cash in hand is equal to cash available minus the cash expenses. Cash available minus cash expense is 423, and 423 will be transferred to the balance sheet. No other change in the capital, no change in the loans, there is no DTL. The summation of the sources side is 7,200, and the no change in the shares. The summation of the asset side should also be equal to 707,200. But the important point here was with respect to the deferred tax. The deferred tax is because of depreciation in the accounting, and is it because of depreciation? It's not because of depreciation in this case, but it's because of the interest, and because the interest is allowed on the payment basis in taxation. So interest has been, no interest is allowed in the tax statement, but interest has been shown as an expense in the income statement. Depreciation is same, so no timing difference due to depreciation, but the timing difference is because of the interest. There is another reason why the accounting profit is not same as the income statement profit, and that's because of the dividends. But dividends fall in the class of permanent differences, because the exemption of the dividend is a tax policy, whereas depreciation, amortization, interest payments, these are to the managerial, are responsible for the managerial decisions. So deferred tax is the tax effects of the timing difference, and if the deferred tax is positive, that appears on a deferred tax liability, but if deferred tax is negative, then it will appear on the asset side as a deferred tax asset. Thank you.